This episode of the Altco's Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts going mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family's sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to creators
Mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Altco's Mainstream podcast. Today's episode is with a private markets veteran who has been working in the private wealth channel before it was called the Wealth Channel. We sat down in the studio with Peter Aliprantis. Peter joined EQT in October 2024 as a partner and head of Private Wealth Americas. He's hit the ground running to build out a wealth team in the Americas and help continue to build the EQT brand in the United States. Peter brings a wealth of knowledge to the private wealth solutions world, garnering over 25 years of experience in the space. Prior to joining EQT, Peter spent 12 years at TPG Angelo Gordon as a managing director, where he focused on new business development and intermediary distribution. Peter and I had a fascinating conversation about what working with the Wealth Channel was like before it was called the Wealth Channel, how to build a new brand in a different geography, how not being the loudest voice in the room can be effective when working with the Wealth Channel, how education helps to serve distribution efforts, and how an innovative and unique approach to education with the Think platform has helped build brand trust and credibility, why institutions are also beneficiaries of the innovation with evergreen structures that were initially designed for the Wealth Channel, how product innovation will continue in the Wealth Channel, and how model portfolios will evolve. Thanks, Peter, for coming on the show to share your wisdom and expertise.
We're going mainstream.
Peter, welcome to the Altco's Mainstream podcast.
Thank you. It's great to be here.
Pleasure to have you. You've had such a fascinating career in private markets, working with private wealth. I'd love to start there.
Sure.
So you've been in this world for a long time.
Longer than I care to admit to.
What was it like in the early days?
So it was interesting. When I first started in the business, private wealth was a much smaller segment of the world than it is today. And it wasn't the cool place to be the way it is now. And so when you talked about distribution in the wealth channel, it was mostly traditional firms like mutual funds, stocks and bonds, trading and sales. And GPs, the way you think about them today on the alternative side or the private market side, were really the realm of institutional investors. And so they weren't a big part of client allocations. So financial advisors, whether they were at wirehouse firms or RIAs, really didn't incorporate a lot of them because the minimums were very high. It was very difficult to service them. Reporting was kind of non-existent. And there was a certain air of, just give us your money, don't worry about it, and we'll tell you about it when we're ready to tell you what's happening. So obviously, that's changed significantly today. And so back then, the large distribution channels, whether they're wirehouses, RIAs, IBDs, you name it, were not really viewed as a significant driver of asset growth for GPs. They were just kind of an exclusive thing that we could give, and it was something that differentiated the offering, the product offering, whether it was private equity or real estate. And so if you fast forward to today, that's really flipped on its ear. And so the big distribution firms now are a major partner with most GPs, and getting shelf space at those distribution partners is very challenging. It's very competitive. And, thus the name of your podcast, Alts Goes Mainstream, is perfect because that's kind of where we've come to. We went from being a little bit on an island over here that was more exclusive to being more mainstream. And I think the results of that are very significant. And how we and firms like ours support those businesses are now driven not by what we want, but what they want, and ultimately what their advisors and their clients want. And that changed the whole dynamic from when I first got into the business.
When did you start to see green shoots and shifts in the way that private banks, wealth managers, and end clients wanted to start thinking about private markets in this way?
If I go back in my history, I think it probably started in early stages after the global financial crisis. People realized that the liquid markets, the more public markets, were extremely volatile. And we had been saying in the industry for years, and it was mostly hedge funds at the time, as opposed to private equity and infrastructure and all the things we talk about today, but that we would reduce the vol. So if you had another downward cycle in the markets, you wanted non-correlated assets to be able to offset your public market assets. And that's kind of, I think, where it started. So I would say probably 2009, 2010-ish. And then it just, I think, accelerated from there.
Did you have any idea that the wealth channel would become what it has become today?
There were a lot of my colleagues and peers who'd started on the institutional side of the business and kind of moved into private wealth. But I always like to say I was kind of in the private wealth business before it was exciting to be in the private wealth business. I hoped it would grow, and I saw the potential, but I have to be honest, I did not foresee where we are today and how explosive the growth has been and how quick. In the last 5 to 6 years, I would say the acceleration has been even more dramatic than it was in the prior 5 to 7 years.
In the early days of working on the wealth business at Angelo Gordon, what was it like internally building out the strategy, the team, making sure that the firm was culturally aligned with working with wealth before it became really a centerpiece of strategy for a lot of firms?
I joined Angelo Gordon in 2011, and they were very committed to growing out the private wealth business because they were able to see that the institutional business was where most of the capital at the firm was, but the longer term, and I think this is what a lot of firms realized, if you really wanted to continue to grow at the rate that you wanted to grow as a firm, and we were a private firm, we weren't a public firm, right? You needed to get into private wealth. So I think the firm was a bit visionary in that. What I spent a lot of time doing, and I think a lot of my peers in my seat would be able to commiserate with this, was convincing the firm that it was a good idea to go down this path, because you needed to spend money, you needed to have resources. And in addition to that, it wasn't just the money, it was the time that you had to get your investment teams to dedicate to coming out and presenting and spending time with advisors, which they really weren't used to. So across the board, I think that was a significant sea change.
How did you go about doing that? I think that still applies today with firms, that the investment teams, or maybe now product specialists, that's become kind of like this Swiss Army knife role in between.
Right.
How do you convince the investment team that this is worth their time and it's an important use of their time to be spending that time with the wealth channel, understanding the wealth channel, understanding that their investments actually impact end clients on a day-to-day basis?
Yeah.
How do you go about doing that?
Yeah, it's a tricky question, because for the most part, we would all agree that institutional sales is not you don't have as many meetings to get to the final dollars. And when you do, you'll get a big check. If it's a sovereign wealth fund or a large institutional pension plan, you get a couple $100 million, or you get $50 million, or whatever the numbers are. Whereas with the private wealth channel, you can get to those numbers in aggregate and more, but the way you get there is very different. So number of meetings and number of what type of interactions do you have to have? Can they be on Zoom? Do they have to be in person? And what's the time drag of your investment team? Because you want them really focused on managing the capital. So there's a balance there. But what ended up happening was there's been obviously a lot of research on this, right? How much the institutional market is growing and what the CAGR is on the private wealth business. And I think the numbers don't lie. There are still naysayers who are not as enthusiastic about going on the road. And to your point earlier, the product specialist role has become very, very important to us because they can fill the gap in many instances around the investment teams. But I think everybody's moving in that direction. And I think we're all kind of on the same path.
On that point, what do you think is the most important skill set or feature to be able to work with the wealth channel? Is it understanding the product? Is it being able to educate? Is it just building a relationship of trust and spending, to your point, number of quality interactions? Is there something that jumps out in your mind that ends up being the most important thing or one of the most important things when it comes to actually working with the wealth channel?
It's all of those things. And I'm not saying that to avoid the question, but clearly I think investment performance is table stakes. So if I'm sitting in an advisor seat, I kind of say, okay, well, if all these guys have good performance, now there are going to be differences between the firms. And in private markets, there's a very large differentiation between the top quartile and the bottom quartile. However, what's becoming increasingly important is servicing and being able to also maintain relationships with large distribution partners. Private wealth is not one-dimensional. There is the sales effort, sales support, the product development group. It's what used to be is, hey, just sell our institutional drawdown structure funds and we'll give them a minimum amount of, capacity and go and sell whatever you can. To now, if you really want to be a player in the private wealth markets, you have to build bespoke products for the channel. So product development, I think, is high up there. Sales support. Then also strategic relationship management, or what now is called kind of national accounts, where you also have a team of people that are supporting the internal distribution partner that you're working with. Then education, content creation, and there's a whole other story around that about what's the cadence of that? How do you make sure it's relevant to the people that you're sending it to so that they'll actually read it or watch it? And then also, which is very, very important, but not talked about as often, is operations and client support from an operational perspective. That's reporting. What do you do? What are you giving people every month? What do they see? Because ultimately, that's what they see, feel, and touch. That's the output for a lot of us. So that's really, really critical.
I think you touch on so many interesting and important things when it comes to building out a wealth business. It's really building a business.
Yeah.
You recently just joined EQT
I
to
did.
build a business from another very good firm, from Angelo Gordon, TPG.
Yes.
What made you decide to say EQT is the place where I want to build a wealth platform?
So I would tell you that some of the best times when I joined Angelo Gordon at the beginning were building the business. I really enjoyed that, taking it from modest means to where I ultimately left. And the opportunity at EQT, I felt they had done a really great job in building the foundational business in the Americas. We're a little different than everybody else on the block, because most of the players that most folks know about here in the Americas or in the US are US-based firms that have been here for a long time that now are extending their presence globally. Well, we're in the opposite situation where we're primarily dominating in Europe and we're moving more to the United States. Now, having said that, the first office here in the US was, I think, 2007 or 2008. And by the way, about a third of our investment portfolio is based in the United States. So we're not new to the United States at all. But we talk a lot about the Nordic heritage of the firm. We're a global organization. We started Nordic and we've gone global. So a lot of people say, well, what does that mean? A lot of the reason why folks haven't heard about us is one of the things of the Nordic culture is modesty. And we are very good at what we do. Make no mistake about it. So from a performance perspective and all of the things we do, and you look at the size and scale of the business, we are very, very good at what we do. However, we don't like to talk about it. So to answer your question very directly, I thought it was a great opportunity because what I heard from people when I talked about EQT was once we told the story to people, to a person, what they said was, how do we not know you guys and how are we not doing more business with you? So that is the challenge, but more importantly, a massive opportunity.
I want to unpack that because I think you hit on something that is so important in the wealth channel, which is building a brand.
Yeah.
There are different ways to build brand, but can you not be the loudest voice in the room in the wealth channel and build a brand effectively?
You have to be one of the voices out there because if you're not, you won't be perceived as a player in the market. We are in the process of brand building, and that's both from the top down. So you're going to see a lot of things happening from us, which is very, very exciting. And then also from the ground up. We have to improve our ground game, so to speak. We've already done that. When I first joined, and it's been a very rapid build out, we had 4 or 5 salespeople in the US, and now we have 12. And we're going to continue to grow that. My group also covers Canada and Latin America, so we'll be building out both of those regions as well. And then you're also going to see more branding efforts. You can't just have one or the other. It has to be a combination of both. If you look at some of our peers out there, that's what they're doing. So you have to have the top down, and then you have to have the ground game. So it's building relationships with advisors. That's very important and very critical. And you have to be present. So you'll see a lot more from us. Stay tuned. A lot coming.
What do you think is the most impactful thing you can do in terms of being present? And I asked that question along a few dimensions. One is you've done really interesting and outside the box things when it comes to content.
Yeah.
The Think platform.
Yeah.
You brought in outside voices, which is different and interesting. You're expanding your brand to people outside.
Yeah.
You've had to hire people on the ground.
Yes.
You built out a team. How do you think about the different ways in which you can touch the wealth channel and make sure your brand is known to people in the wealth channel?
For all of us is kind of the holy grail to a certain extent. Everybody talks about the wealth channel, but I don't see it as a one-dimensional market. So when you're thinking about content or how you reach out and touch an advisor, I think there are multiple segments of advisors. The way you address a wirehouse financial advisor is going to be different more than likely than how you reach out to an advisor at an RIA. And even within the RIA world, there are the aggregator RIAs, and then there are 17,000 or so RIAs in the market. So you have to figure out what the best way to develop that content is, and also segment each of the pieces within those groups. So if you take wirehouses, for example, there are advisors that have been working in the private market space for a long time. So those folks are going to want to see some much more information around investments. And then there's a whole swath of advisors that are just getting into alternatives. So the content that you develop for those folks might be more educational in nature to help them understand how to incorporate a particular strategy, private market strategy, in their overall client allocation, because right now they might not incorporate those funds. It's not just pushing a bunch of stuff out and hoping a couple of them stick. Here, it's about defining the markets, quantifying how to relate and communicate to each of those markets, and then figuring out the appropriate content to get to those markets. It's a lot.
One thing you're really impressing on me when you go through that explanation of how to think about the wealth channel and educating and branding within the wealth channel is that you're building a business.
Yeah.
A business requires resourcing.
Yes.
You have to do certain things with the resources you have, and then you figure out how to build and grow the business.
Yeah.
How do you think about what I just said in terms of resourcing and capabilities in the context of the segmentation of the wealth channel? Because just to cover wirehouses, that requires a certain amount of resourcing.
It does.
Not every firm can do that, as you know. Certain firms can. Same with other segments of the channel. And also that there's going to be types of clients who may not be the client you start with, but in 5 years' time, going to be a really important client segment. So how do you think about the strategy of building a business? And I'm getting you when you're doing this real time.
Yeah.
You joined
Yeah.
4 months ago.
Yeah.
How do you think about building the business strategy
Mm-hmm.
for working with the wealth channel?
So part of it is doing that market segmentation analysis. There are probably 5 different segments. The ones that are obviously well covered are the wirehouses, the RIAs, but like I said, even within those, there are differences. Then you have independent broker dealers or IBDs. They're a little bit different. And then there's single family offices, multiple family offices. And then you also have firms like Case and iCapital, who are kind of intermediaries to help you build relationships with all of those other folks. And so you have to think about the whole swath of the private wealth markets, because that pretty much covers it all. And when you start out, I think probably most of my colleagues and peers would agree that the velocity of the capital is probably strongest in the wirehouses. And then the next is usually the RIAs. The time to close business in the RIA channel is a little bit longer. I was at a conference a couple of weeks ago, and there was some research that talked about how long it took from the first time you had a meaningful interaction with an RIA until the time you actually closed business. Do you know how long that was?
I guess 9 to 12 months.
2 to 2.5 years. So it's a long process.
What was most effective in building that relationship with the RIA?
They want to see you as somebody helping them from an advice perspective. If you're showing up and you're just selling your fund and pushing your product, that's probably not going to go over as well. We were talking with one of the RIAs, fairly significant RIA, and we said to them, well, why does it take 2.5 years? Do you agree with that? And if that's the case, why does it take so long? And his comment, now this is not necessarily a trend, but I think it's relevant, was we want to build a relationship with you, and we want to see how you progress over time and how you relate to us. Do you just sell us and then you disappear? And also they want to see performance, especially if it's a new fund. And a lot of the evergreen funds that firms are developing are still relatively new in terms of track record. So they want to see how they progress. But I do think, we didn't talk about this yet, but having specific products for the channel is also very important. In other words, and I think I mentioned this earlier, but if you just want to go out and sell your institutional funds, you'll probably still raise some money, but not as much as you would if you built bespoke products specifically for the wealth channel.
It's a really interesting point, because I think that gets to a question around, does the wealth channel want what the institutions have had? And is that a way in which you can sell it? Like CalSTRS is investing in this fund.
Yeah.
300 billion plus pension plan. That's a stamp of approval.
Yeah.
If you sell that story, does that work? And is that effective with the wealth channel? Or do they want something that's very unique and different? It doesn't need to be, here's what the institution's got.
Yeah.
I'm getting it now too.
Yeah.
Is it something else?
On the more traditional drawdown institutional funds, that was the case. They wanted to see that big institutional money that they perceive as the smart money is getting into those funds. And if they got in, well, they all do their own due diligence, but it's nice to know that you're not in the pool by yourself without a lifeguard, so to speak. But as it relates to the bespoke products, and you mentioned this earlier, my colleague Peter Besky talked about this. And I agree, because the dynamic that you see in institutional markets is a lot of small to mid-size institutions don't have big investment teams to do investment due diligence and spend a lot of time every time you come out with a drawdown fund. So every year and a half, they have to re-underwrite your fund. And maybe you haven't gotten all the capital back yet. So there are a whole bunch of issues around that. And so over time, a lot of those small to mid-size institutions are going to look at the evergreen structures and say, hey, you know what? The returns aren't that different. We don't have to keep re-underwriting the strategy every year and a half or 18 months. It's the same investment team. It's the same people we already know. Why don't we do that? And it makes our lives easier. So I absolutely think that that's coming.
What that gets to is a really interesting question. You kind of alluded to this earlier when talking about the wealth channel taking 2 to 2.5 years. What comes into my mind is that you
The
need to
RIA
be,
channel,
yeah, or
the
sorry,
RIA
in the,
channel. Yeah,
in the
yeah.
RIA channel,
Yeah, yeah.
you need to be a solutions provider.
Yes.
So you need to come with consultative
Yes.
approach, helping them figure things out. That gets to what you just said around how do we help clients, whether they are in the wealth channel or institutional channel,
Yeah.
particularly the small F&E
Yeah.
category.
Yeah.
How do they actually have a solution? Do you think we're going to get to the place if more firms are using evergreens,
Mhm.
where whether that's the wealth channel or the institutional
Yeah.
channel, where firms are alternative asset managers and traditional asset managers for that matter are going to just try to create solutions where it's here's a model portfolio, here's a package, or here's a way in which you can think about asset allocation that
Yeah.
involves both evergreen structures and closed-end funds. Here's why this structure makes sense. Here's why that structure makes sense, and really help them put it all together.
That is absolutely, I think, coming. I don't know when. And from where I sit, that would be great, because if you think about where the wealth money is going to come from in private markets, is it's going to have to come down market. If you're an advisor and you're new to private markets and your clients don't have 20 million or $40 million to invest, it's harder to go and select individual managers, one for private credit, one for private equity, one for infrastructure, one for real estate. And that's complex. It's very difficult. So I think you're spot on. What's going to happen over time? Again, I don't know when. And I think we're already seeing the early stages of it, where models will be created that if you're new to private markets, hey, we now have this model where it's just invest your client capital here. We're going to do the allocations for you across private equity, private debt, real estate, infrastructure, and all of that. And then the advisor can say, oh, I like that. That's great. And from our perspective, we love that. It has to be approved in the model, but it makes it a little bit easier for us so we don't have to go out and sell it to thousands and thousands of advisors all over the country.
That gets to a interesting business strategy question, which is, as a firm, if you then have these various strategies or solutions for clients across private equity, you have growth and venture, you have private credit, you have real estate, you have infrastructure.
Right.
Does that mean that firms will need to be able to have a one-stop shop solution for clients where you're able to build the brand, show that you are competent investors in each specific category, and then people will choose a firm to work with, and they will work with that firm across strategies.
Right.
I'm sure that already happens within the institutional side, and that's continuing to grow, where now firms will use multiple products within a platform.
Yeah.
But then on the wealth side, you think about things like models. What if there's an EQT model?
Wealth distribution partners in general prefer to have less GPs that have broader investment mandates, private equity, private credit, you name it, across the board, because they also have limited resources with which to do due diligence, operational due diligence, investment due diligence. And then on top of that, think of their sales teams. Those sales teams have to go out, and let's say it's a wirehouse, alts kind of sales team. And if they're distributing, I don't know the numbers, but 100 different funds, how well can you really know each fund? Being able to limit the number of GPs you're working with gives them more scale. I don't think you have to have every single asset class, but I think you have to have a lot of them. But importantly, that doesn't mean that if you're a niche firm that doesn't have all these strategies, doesn't mean you're out of the box. They play an important role because they'll be different and they'll do things differently. Maybe they're smaller, maybe they're private. They technically can be more nimble depending upon which asset class they're in. So I think there's room for everybody. It's just the market is getting much more competitive and it's harder and harder to get shelf space.
Because that's such an important aspect of this, like getting shelf space at a wirehouse, that will likely be the domain of a certain number of firms, because you mentioned this earlier, you have to be able to resource working with a wirehouse. And the wirehouse, the CIO and home office, they need to know that you can actually work with all the advisors. Because it sounds like you actually have to go and do that work. That's your job, but you have to be resourced from a distribution perspective and a product specialist perspective to be able to do that.
There are a number of things over the years that have become very important in getting approved at these home offices. It's also different with some of the private banks than it is with the wirehouses, because with some of the private banks, they kind of do all the sales. Our sales guys don't necessarily have to go out and sell. They have their own internal sales. So we do teach-ins. We get our investment teams and our investment guys to go out there and teach them, and then they go and sell to their private bankers and ultimately to the clients. So there's not as much active sales involvement from that model. But when it relates to RIAs, wirehouses, and the rest, then it's part of it. Part of getting approved is we have 16,000 financial advisors in our system. How are you going to handle that with 3 people? So there's been this increasing emphasis on size of sales force. And in addition to that, home office support. We do these conferences. We would like to have your senior folks, whether they're the investment team folks or senior people in your organization, come and speak and talk about the firm and talk about what you do and how you do it. And that's part of brand recognition and branding and all of the things that go around that. And those are very important aspects of it. And then again, what can you do for us from a content perspective? Because remember, they don't have unlimited resources at our distribution partners. And so they look more and more looking to GPs like us to be able to assist them in the education and help with incorporating private market investments in their overall client portfolios.
When you say that, what comes to my mind is scale matters.
Yes.
In this space. If you want to work with the wealth channel, you need to have scale to work with certain segments of the wealth channel.
Yes.
You also mentioned before about smaller firms doesn't mean they don't have a place. They just need to find their place to be able to work with the wealth channel.
Right.
How do you think this all shakes out?
It's going to be harder if you're a smaller organization without size and scale. But all that means is you have to temper, I think, your expectations on how much capital you're going to raise. Like if you're a smaller private company, well, maybe you don't have to raise $50 billion. Maybe raising $2 or $3 billion is going to get you where you need to be. And that's great. So I think there's a space for everybody. It's just, where do you fit within your expectations?
Brings up an interesting question because the largest firms are on a growth path as a business.
Yeah.
They're growing the size and scale of their funds.
Right.
There's benefits to that too.
Sure.
There's only a certain number of firms that can do certain deals as a result of that. And that can be a driver of returns.
Sure.
But I imagine there's also a class of LPs, whether institutional or wealth channel, who are asking, okay, as size and scale of funds increase, do returns go down? Now, you look at your recent earnings call report, and there was a chart in there that shows bubble chart of funds get bigger for EQT, yet performance didn't necessarily fall off.
Yeah.
How do you think about that aspect of things from a business building perspective? 'Cause I think it's a really important point. The business side of building alternative asset managers ties in, is inextricably linked with the investment side.
One of the things I can tell you is that performance is the driver of every decision that happens at the firm. When we think about growth, there is always the conversation around how will that impact, if at all, performance to the upside or to the downside. And that may differ based on strategy. It might be a different answer for a venture, might be a different answer for the buyout business, it might be a different answer for our Asian private equity business. But I think at the end of the day, the culture of what we do is global in nature. About a third of our investments are in the United States. But I don't think you can avoid what's happening in the rest of the world, whether it's Europe or in Asia. There's tremendous growth in Asia. The reason we're able to continue to raise larger funds is the universe of investments that we can pick from is very diverse. It's not unidimensional. It's not just the US. And, a lot of people talk about, well, Europe has been somewhat stagnant. We're worried about it, how it's going to grow and all that. And the reality too, and everybody's talking about this ad nauseum, right, is, well, public markets are shrinking. They're not growing. Companies want to stay private longer. They don't want to be in the public markets. So the opportunity set for us and what we do, and remember, we're control investors for the most part. We're active investors. We're not passive. We don't do secondaries. We originate. And so what that means for us is we have a lot of levers that we can control if things start to go the wrong way and don't go the wrong way. And we've got a 30-year history of investing in private markets. So I think when you combine all those things together, it gives us a much bigger funnel of opportunities to choose from. And the private markets in Europe and Asia are extremely plentiful for us. And we see that as a fertile hunting ground for us.
You talk a lot about being global. You've obviously been global as a firm for a number of years now. You've been in the US for a while, 2007.
Yep.
But coming to the US from wealth channel perspective and building a brand, what do you think are the advantages and also challenges of being a European firm with Nordic heritage
Yep.
that is now coming to the US?
Yeah. Part of it is people don't know who we are. Now, my experience and talking to our existing private wealth sales team has been, and we did some distribution with some of the wires and some of the RIAs, obviously. What was the comment when you talked about EQT? It was very positive. It was, we want to do more with you. How do we not know who you are? And so the challenge, I don't think, is being a European firm necessarily. I think the challenge is getting the word out and being able to tell it to two friends and they told two friends and so on and so on. So the idea, I think, from our perspective, is to be able to tell the EQT story, tell the Nordic story, and show performance and say, hey, by the way, it's not just theoretical. Take a look at what we've done. We might be quiet and modest, but by the way, look at what we've done. It's pretty good.
What do you think is the biggest challenge with differentiating a brand with the wealth channel? How do you show to investors that your firm, your DNA, your culture, your brand, your orange, which is interesting, that stands out. And I think I know that sounds like a flippant comment, but I don't think that can be ignored, because it's like you have to find ways to stand out and be different and unique. But what can you do? And what are the biggest challenges with building a brand in the wealth channel? When I think there was this Bain and Company report that showed, they asked people, who are the firms that invest in private capital?
Yeah.
And the first answer, most common answer, was, I don't know.
Right.
So how do you go about actually showing who you are and also differentiating who you are from your peers, the other firms that are there?
For us, very important, obviously, right? We're going to have some significant firm level branding coming out. So I don't want to let the cat out of the bag, but sometimes being the new kid on the block is an advantage, not a disadvantage. A lot of our competitors have had a longer runway than we have had in the private wealth space, in the Americas specifically. They're very well known. They're very well accepted in every street corner from here to Oklahoma. So what happens over time is sometimes people look for new alternatives. And they say, hey, everybody's selling this firm or this strategy or that strategy. Is there anything out there that's different and differentiated? What you can do is turn a challenge into a real positive and grow on that and say, look, we don't walk the same, talk the same, look the same, but look at what we do and how successful we've been over the last 30 years. And we can back up what we say. We've driven performance and value creation, significant value creation for our clients. It's a combination of those two things that will help us get to where we want to be.
At the end of the day, is it just performance that sells, whether it's institutional channel or the wealth channel, or is it other things as well?
I think it's other things. I think performance is very, very important for obvious reasons. But having said that, what hasn't changed over the years in this business is advisors want to view you as a source of advice, not a source of product push. If you can have a substantive conversation around private markets, like when we talk about Europe or Asia, we talk about how much of those markets are private versus public. How many companies in Europe and Asia with revenues of north of $100 million there are? It's an astounding number. So that puts in the advisor's mind, well, hey, I don't know how much exposure I have to those markets. And then you can talk about, well, how do you get exposure to those markets? So again, I go back to this combination of bottom-up ground game versus top-down.
How do you hire distribution professionals who can sell without selling?
When you're younger in the business, you're eager and you're worried about your sales numbers. And all of us who are in sales are always worried about our sales numbers. But for those of us who have been doing this for a while, realize that it's more important to build longer term relationships and be more advisory than sales. Now, there may be times when an advisor is looking for something specific. And when you're selling a drawdown structure fund that's got a limited window, a time frame of 3 to 4 months, you can't really be that strategic, because if they don't get in those 3 or 4 months, they got to wait till the next vintage fund. So I think that's more relevant probably for the evergreen structures than it is for the drawdown structures. Right?
Brings up a really interesting point about how to orient a sales effort,
Yeah.
right? Because an evergreen fund, there's a continuous sales cycle.
Sure.
There's also a continuous management of that fund. But does that really change the dynamic of how you can then interact with advisors? Because yes, obviously you want as much capital as feasibly possible.
Yeah.
There's a limit,
Yeah.
I'm sure, as well, in terms of what you can deploy.
Sure.
But that must change the cadence with which selling happens.
It definitely does. If you're in market with a traditional drawdown structure fund, you have a fuse. And everybody knows if you don't get in within this window, you got to wait another year and a half, whatever it is, until the next one comes out. Whereas with an evergreen structure, most of these are available monthly. So if you don't get in this month, we can get in next month. So there's a certain amount of salesmanship that goes into this. But I think more importantly than that, when an advisor is putting together an allocation, it's much easier to allocate to an evergreen strategy. Because when you allocate with a drawdown structure, do you put the allocation in as the commitment size or the currently invested size? And what do you do with the cash? And that, based on all of the input that we have, favors evergreens over the longer term. It doesn't mean that drawdown structures are going away. They're not. They're going to continue to be a portion of, but I see it more as a core and satellite, whereas the evergreen might be the core. And then when you have a specific focus or want to invest more heavily in a particular segment that you have a real penchant for, you can do that in a drawdown structure.
Where are we in terms of the development of investor psychology of how to think about investing in evergreen structures?
We're further along than we may think. And I'll tell you why I say that. So I had been in the credit business for quite some time. And private credit, direct lending, when it first started, when it first became popular in the private wealth space, the only way you could really access it was in a drawdown structured vehicle. So it was 4-year investment period, 4-year harvest, capital calls. And then there was the advent of the evergreen BDC model, which was evergreen, could buy in monthly, had limited liquidity quarterly. And by the way, the returns and the yield wasn't that different than it was on the institutional funds. So what happened in the private wealth space was, hey, why would I lock myself up when I don't have to? And I'm going to go into the B. So now the reason I bring that up is most investors are very comfortable investing in evergreen private credit or BDC type products. People that have already done that on the private credit side, I think are going to increasingly look at private equity and infrastructure and say, hey, we now have these evergreen products in both private equity and in infrastructure. So why wouldn't I do the same thing I did on the credit side on the equity and the infrastructure side? So I think it's already starting. I don't think there's necessarily a big wave yet, but I do think you're going to see more of a migration. And because also advisors can allocate, and most of these are available to accredited investors. So they can push it across their entire book, whereas before they could only allocate to their qualified purchaser clients.
This also ties in something you said before, which is the dynamics of private markets are changing. Private companies are staying private longer.
Yeah.
Infrastructure is also an asset class where projects might take 15, 20 years.
Yep.
So having these investments in an evergreen structure, I think Henry Jones talked about this in a recent Think post as well.
Yep.
But the dynamics of private markets changing also might actually make evergreen structures the right structures for a lot of these investments. But also, and I want to hear your thoughts on this, it might actually just fundamentally change the dynamics of company building. Like, does this mean companies will stay private in perpetuity because there's now structures that can support that?
Companies stay private for a myriad of reasons. And those reasons may be different in the US versus Europe versus Asia. But for the most part, I think the trend is definitely private, not public. And that's the same across all markets globally as we see it. It's hard to say what they're going to do, but I don't know if they'll stay private indefinitely, but they're definitely staying private longer, unless the rationale might be, okay, we want to grow exponentially. And in order to do that, we need public market capital. A lot of these companies are also family owned.
You mentioned family run companies. I think that's actually a really good tie into the concept of evergreens. And it ties in with EQT's history too.
Yeah.
The Wallenberg family.
Yes.
While EQT is no longer family run per se,
Correct.
it's a public company.
Yes.
Anyone
Went
can
public
buy
in
this,
2019.
can buy the stock.
Yeah.
The Wallenberg family still owns a large percentage of the company's stock.
Yes.
How does being a family owned business, not in its entirety, but
Yeah.
still having the heritage of a family owning part of the business, how does that impact the culture of EQT?
Most folks in the US might not know who the Wallenberg family is, but I would say they're somewhat equivalent to the Rockefellers. They're a big industrial family with lots of ties to investing and have run companies and understand what it takes to manage a company, build a company, start a company, sweat equity, all that kind of stuff. And when Connie Johnson started the company back in 1994, a lot of that mindset of how they thought about their personal investments bled into how we started EQT as an organization, and started in the Nordic countries and ultimately became very, very successful with that investment model, and slowly over time built out a global franchise. But a lot of those cultural values permeate the firm today, both from an investment perspective as well as how we treat each other. So if you think about it, what does that really mean? What are the Nordic cultures? Well, a lot of it is modesty, transparency, entrepreneurialism, highly effective, and also early adopters of technology, all things that are very, very relevant to how we invest and how we run our own company. And that permeates the firm from the top to the bottom.
When you think about what that means for EQT as a business and where you can go as a business, you're building a business within EQT with your colleagues as well. The wealth business is only in its early days,
Yeah.
both within EQT and also within the industry. That long-term mindset, how do you think about that as you build out your wealth business?
Yeah, it's always interesting. As a private equity firm, we have a much longer term horizon on how we build businesses. That's the nature of private equity, being able to not have to worry about the gyrations of the public markets, but you can manage your business over time without the necessarily time constraints of having to push it out to the next quarterly meeting. And we are in the process of building this business. I think we're a pretty far way down the path. We have some pretty aggressive targets for the next 3 years that I think are very attainable. And importantly, the firm is very, very supportive of what we're doing in the private wealth business across the world. We now have about 100 individuals globally that are focused on private wealth. And that includes product development, sales, strategic relationships, and that includes dedicated brand building for those channels. When I was interviewing for the opportunity here, one of the things I said was, I think we need to work on brand building. And they already had a plan. And the other thing I would say that's really critical about this is building bespoke products for the wealth channel. So we currently have 3 evergreen products that are specifically dedicated to the private wealth channel. And in 2025, we'll be coming out with another 2. So by the end of 2025, we'll have 5 very specific bespoke evergreen structures that are dedicated just for the wealth channel. And this gets back to your question earlier around how are the bigger companies going to do versus the smaller companies? The smaller companies, typically, if they're private, they don't have balance sheet capital. So if they're going to create a new vehicle like an evergreen structure, they don't have many options. The only options are really to go to institutional clients and get them to seed it. And usually you have to give them some kind of GP economics to get them to come in, which cuts down on your margins. But for us, all of our evergreen structures were seeded with balance sheet capital. So it's important to have that backing from the firm.
Does that mean, when you say all of this, is the time now for the race to win the Wealth Channel?
Yes, I think the race is on, and I think it's going to be a sprint to the finish. It's very, very competitive, but I do believe that there are enough differences within each of the firms that are out there to be able to have space for everybody. And the reality is advisors aren't only going to invest in one manager. They're going to want to have manager diversification as well as product and investment diversification. So I do think if you're not in it in the next 3 to 5 years in a big way, it's going to be difficult to catch up to everybody else. Yes.
I think that's a really interesting point to end on because we touched on so many aspects. You've been in the wealth space for so long. To some extent, it's about running your own race, right? Every firm will run their own race in their own way, but the time is now.
Yes, I agree with that.
So thanks so much, Peter, for coming on the show.
It's been a great conversation. Thank you very much for having me today.
Pleasure to have you. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going